All right, welcome back, traders. John Caruso here, February 7th. We're going to do a quick hitter on the S&P 500 and some things that we're seeing right now. Clearly, what we're staring at here is a very strong tape here over the very near term. Obviously, since the beginning of part of the year, we're up roughly about 6.5% in the S&P 500. We have put on a lot of weight in this market in a very short period of time. This gray shaded box that we have over here was highlighted as a period of resistance. That's just basically following the 78.6% Fibonacci retracement level and these past peaks and their inability to really explode through that 78.6. What we're seeing right now, clearly we did get back above the 78.6. If I zero out right here, we did not quite think that we were ready to get to the 100% retracement, which of course would be above this past peak that we saw back in August. And right now we are starting to see the market give back some right now. We're trading 41.11. That's down about 32 basis points on the session right now. And what I'm watching for, and I'll zero in a little bit closer, I'm watching to see if we can take out yesterday's low, which comes in at 41.40, or I'm sorry, 41.04. And perhaps that could be a signal that we're going to see some more runoff here into the center line of the Bollinger Band that carries us into about 40.60 or 40.50 before we see this market try to stop, reverse, and reattack these old peaks up here and potentially slightly beyond to 42.20 to 42.30, somewhere up in that area. Now, why do we think that 41.50, if we are to get to this level this deep, why do we think that that's going to stop the rally? Well, we have a very strong tape in here. This upward bias is very strong. I am currently getting an immediate term oversold signal down here in my oscillator. So if this market doesn't stop and reverse today, potentially we could see some runoff as deep as 40.60 before it stops and reverses to reattack these highs. But as you can see, the central theme is here. I do expect this market to stop and reverse, reattack these highs one more time before we see another bigger period of risk that happens as we move into March and April. We still remain largely cycle bears on the market, but recognize that we do have a bullish trade that's going on here. And some of these bullish forces, it's going to take some time to sweat these off before perhaps we get a bigger period of risk somewhere deeper out into the spring. I'm John Caruso. That's a quick hitter on the S&P 500. Best of luck to you out there.